never get out of the boat, and it's never too late to get in the boat. We had a sluggish start to the year, which is great because we digested the move of the fourth quarter
Right.
of 2023. And I think the market's telling you that we're normalizing, we have a more normalized rate situation,
Right.
normalized growth situation. You got to be in.
There's quiet skew, there's a quiet within the internal dynamics, but the bottom line is it's a wall of money looking for a warm spot. Does
$6 trillion in money market funds, $6 trillion.
People are saying, oh, it would never go to equities. I'm like, are you kidding me? Yeah, it is. In what way will it go to equities?
It'll go to equities in several ways. The first is that there was a rush to money market because of the banking crisis in March. And you had folks who stayed there because they could sleep at night and it was the easiest place to be. We've been telling our clients all last year, get out of cash. It's set to underperform over the next 12 months. So we think a lot of that angst that happened about a year ago comes into equity markets, and it should be coming to the bond market as well. Because you're in a world where the Fed's not hiking, and it's either going to be the same or lower going forward, and that's very positive for risk assets, bonds, and equities, and you got to get in. I can't tell you how much of that $6 trillion is coming out, but a lot of that $6 trillion is the expression of angst over the last year of the rate environment.
So, Alicia, if I do want to stay in that boat, if you will, do I try to chase those big cap tech stocks that worked so well in 2023, or do I say, miss that boat, let me try to find some value in other sectors? What are some of the sectors you guys like?
So we have said I was here a month ago talking about our outlook, and I had this phrase, dance with the one that brought you.
Okay.
Meaning everybody wants to go to small cap
Yep,
or to
yep.
go to international EM, and I say, you know what? That's probably a great trade and it'll work for 3 to 6 months, but ultimately if you're building wealth, I want to be where capital's treated best, and I want to be in the companies that throw off cash and don't need to borrow.
Paul, first grade insight of the week, Alicia Levine, BNY Mellon. I'm going to talk my book, folks. I can't say enough how the similarity to 23 is there. You got to find cash flow, quality cash flow, however you determine that. To me, it's a triple leveraged all cash fund. Maybe
Of course.
something more optimistic for
So,
you.
Alicia, on the fixed income business, our friends in fixed income actually made some returns last year after getting crushed in 2022. What do you think about this year? Where do I go in the fixed income space? I was shocked that last year the best performance was high yield.
That's right.
And
because we had no recession.
Yes, I
Right.
guess that's the point. A lot of
Right,
talk
no
about
recession.
recession, but no real recession.
So look, we like the belly of the curve. We're not saying go out to 10-year yet. We think that's just too long in duration. We like the 5 to 7 year range for govies right here. We do like investment grade here. That's sort of a sweet spot. We don't expect a recession, and with that, you're going to have, a more normalized year of returns in these asset classes.